manage to get some level of seed funding still fail to reach a liquidity event. 28% of them exit through M&A. And so the rest, the people who make it all the way through the funnel, either exit after a Series C at a very high purchase price or presumably go IPO. Now, the interesting thing about all of this is that of the 28% of companies who actually do exit through M&A, a bit more than a quarter of them managed to exit with a valuation of over $50 million, which obviously means that the vast majority of exits for U.S. tech companies are under $50 million. So these numbers just frame the story. But what you need more data to understand if those exits were good for the founders and the employees, or if they weren't. So when I advise startups, I advise them to think about how to identify the best times for an exit, how to know whether to keep going and scaling their company or to take an exit opportunity, and then how to plan for the best exit you can get. And that's what we're going to be talking about today. And the thing is that I found most founders I know don't think about acquisitions the same way that acquirers do. They have a tendency to think about exits the way VCs do. The problem with that is that VCs want you to do the same thing. They have one defined path to what they call success. But you know that there are other options that might create outcomes for you that you would consider successful even if a VC doesn't. So what I'm going to talk to you about is how VCs think, how I think startups should think, and how acquirers think. And let's start just by recapping what we know about how VCs think. Something I'm sure you've already understood, but this is a refresher course in VC math, let's say. So let's say a VC raises $1 million from one of its limited partners. Generally speaking, that LP is looking for about a 20% cumulative average growth rate to its investment. And generally speaking, VC funds last for about 10 years or so, although these days they seem to be going for even longer. So if we just hold with a 10-year fund term, what you find out is, based on a CAGR formula, the LP is going to want back around $6 million at the end of the term, or a 6 times return rate on its original investment. Now look at the numbers from a VC point of view instead of the LP. You've got a VC firm, and data suggests that only about 20% of the VC investments are returning enough to allow the VC to give that LP their 6 times rate of return. And again, some numbers suggest that some VCs are batting even lower than that. So if a 6 times return is needed, and it needs to come only from 20% of investments, that means that what a successful investment has to return to the VC is on average around 30 times return. And that's fairly large. So let's now look at what happens if a VC invests $10 million in your company. So they have less than 10 years before their fund expires, right? Usually they're not investing on day one of the new fund, and then they've got the full 10 years. So you might only have 4 or 5 years to be able to return the amounts that they need. And so they're going to push you to grow large enough so that they can get a $300 million return out of your company for a $10 million investment, because 80% of their investments aren't going to be able to realize anywhere near that amount. What does that mean for you? A VC normally will expect a minimum of 20% equity in your company, sometimes more. And so just basic math means that you've got a pre-money valuation if you're getting $10 million in of about $50 million. And so for that VC to get the $300 million back from you, the overly simplistic math says that you need to grow large enough to be able to sell yourself for about $1.5 billion off of a $10 million investment. And CB Insights says that that puts you at about 5% or less of all companies that have already received seed funding. So if you're not satisfied with that 5% chance of success, all you have to do is remember that you're not a VC. So those economics don't necessarily apply to you. So the rest of this presentation talks about the framework for thinking about growth differently, thinking about growth from a startup perspective, not just from the hyper-growth that VCs talk about and obviously the media has caught on to, and they talk about too. And what I talk about is asking startups to think about 3 questions. First, is your definition of success different from that of a VC's? And if so, what is it? Based on that definition, how much do you think you should be investing in scaling your company? And since basically all startups that don't fail get acquired, very few go IPO, why wouldn't you be regularly assessing your exit opportunities along the way? So let's take time to answer these questions one by one. I can think of a number of definitions of success for a startup after having talked to a lot of founders and been one myself. Some of you might align with a VC's definition of success. You might be looking to prove that you can build a startup to show that you're up for the challenge of scaling into a really large company, and that's what you're really driving for, and that's great. But others of you might be focused more on getting the great products that you've developed out there in the world to use by millions of people, and that would be your definition of success. Some of you might have started a company mostly because you like running your own show, although oftentimes when we engage in a startup, we find out that that's not, that's not where we end up. But my experience is that more than a few of us go through all of this pain hoping to get some significant financial return for us and our team out of this effort. So the reason you want to define your definition of success up front is because different definitions have different impacts on how you grow your business. The best way to explain this to you is to talk about what I like to call the life cycle of a startup in terms of valuation. And I'll start by showing you this graph, which hopefully many of you have seen. It was created by Paul Graham, the co-founder of Y Combinator, among other large achievements. And what we did at Tribal is we took Paul's original idea and we changed it a bit to fit what we think a startup valuation curve looks like. And the first thing you'll notice is that unlike how you picture this curve in your head, it doesn't just go up and to the right all the time. The second thing you might notice if you have really good eyesight and you're looking in the bottom left-hand corner is that unlike apparently everything else in tech these days, this isn't based on terabytes of data analyzed using artificial intelligence. It's based on our discussion with dozens and dozens of companies that have either grown and then chose to exit or grown, tried to scale, and failed to exit. So the x-axis of this diagram is either time or your amount raised. The y-axis shows the value of the founding team's equity in the company over time or over the amount raised. And you can see it changes. It doesn't always just go up. So understand when I talk about value, it's a notional concept, right? It's notional until one of two things happen. Either someone is willing to put real money in exchange for a stake in the company, or someone is willing to actually just buy your company outright. So it's either an investment or an acquisition. That's when value becomes tangible. Any other time we can talk about how much we are valued at, but it's not necessarily representative of reality. So the first real opportunity for an acquisition, or usually an institutional investment to occur, comes as the business is starting to show that there's a product market fit, what people like to say in the industry, a product market fit for the product they're building. And there's a lot of different definitions of what product market fit means. So I'm going to give you what my definition is, which we've created because that seems to be the point where the first acquisition opportunity hits you. So in the B2B world, you can show this this milestone point, what I call a product market fit, by showing that you have at least a handful of customers that are willing to actually pay for your product. This is shorthand for someone else looking at you and saying, oh yeah, no, you've built something that works because people are using it, and also that it's valuable because people are paying for it. You don't need a lot of people to be using and paying for it at this point, but you do need some real customers, some B2B customers. In the B2C world, you need a lot more proof points. And knowing when you've actually gotten to that point is a bit murkier. How many customers do you really need regularly using your product before you can say that you've found a market that accepts it? That's the question that you're trying to deliver an answer for. But once you can show that product market fit, and if you have a solid team behind you with deep technical domain expertise, you'll find two things might happen. First of all, an acquirer might actually come knocking on your door. And second of all, if you're looking for investment, it's easier to get that first healthy seed round, or maybe even a small Series A round. And that's an indication that you've reached your first peak valuation. Now after that, it would be nice if things kept going up, but it's not obvious that once you pass that product market fit stage, you're sort of likely to see a drop in valuation. If someone was to come to you at that point and tell you how much they would buy you for, you would find that it would be at best equal to that high point, and perhaps even lower. And that's not an intuitive thing for startups to understand. So I'll spend more time in just a bit explaining why that is. But if you make it through that valuation valley, our trough of dissolution, then you get to a second maximum valuation point. And that's the point where, again, we deal with mostly with a lot of B2B businesses. At that point, you're probably bringing in, I don't know, somewhere between $1 and $5 million in product ARR. And I specifically say product ARR because you're switching from some revenue stream that is sort of half product, half NRE, but you really need to be switching it and making it a product revenue stream at that point in order to be hitting that second peak. We worked with a company that was in that range, but because they hadn't been able to productize their products very well, and a lot of their work was being done in NRE, they were having a problem both raising a Series A and getting interesting acquirers to be interested. There's initial interest, but it would drop off when they understood the details of the business. So the critical additional value that you've added to an investor or an acquirer at this second peak is that you've shown that you know how to capture this particular market segment. So from an acquirer's point of view, they would be getting some value in time to market by acquiring you, because perhaps, hopefully, they haven't explored that market segment yet. You have. You haven't captured it all yet, but you're showing them that you've already figured out how to do it. And so that increases and helps them from a time to market perspective. That's why everybody scrutinizes your customer acquisition cost at this stage. So if you've spent $7 million making $5 million, you really haven't shown yet that you know how to capture this particular market segment. And you won't hit that valuation peak. Now, what happens after that second peak, let's get there, is that you need to invest in what Jeffrey Moore calls crossing the chasm, right? So moving from those early adopters to the early majority customers. And that means a lot more investing, usually more in sales and marketing. And you're adding administration, legal, finance, operations teams. It's a whole different scaling challenge and a lot of new risk that comes into that company. If you're a B2B company, only when all of that new investment generates at least a 10 million plus product ARR with annual growth rates that are quite large, do you start seeing that up into the right curve that you always used to draw in your workbook when you were in biz school. That's when you get to that point. But there's an entire set of inflection points before that startups don't often think about. So the value you have added at this last stage is that you've shown you can build and lead a team that can execute and drive predictable, growing revenue in a market segment. You've de-risked the process of creating a working business for an acquirer or from the more conservative growth VCs. And that's why you get a new round of interest at a new level of valuation to invest in you. So now that I've walked you through, admittedly an oversimplification of the valuation high points in a startup company's development, let's look at the founders whose definition of success may be to scale a company to over, let's say, $20 million in ARR, which would put you at a valuation of over $100 million on average, 5 times revenue, and therefore you'd be one of the select 4% of U.S. seed-funded companies that managed to get there. So to scale to this level, you're going to have to cross 2 chasms. The first one is going from proving that the visionary customers out there want to buy your product to proving that you've figured out how to capture this market segment. You understand how to do it. And for that, you probably need to grow your business to around 3 to 5 million in product revenue. For some companies, some might be less, others might be more. And if you don't hit that milestone, that second green circle milestone, you might find yourself in a down round or facing a potential acquisition at a much lower purchase price than you expected, given the amount of effort you've put into your company and probably the amount of money you've put into your company so far. So to understand why, you have to take a break from thinking like a startup and understand how an acquirer thinks. So an acquirer doesn't attach value to the amount of money you raise. In fact, oftentimes the investors in your company aren't something that an acquirer appreciates, because when they spend money on you, the money goes to the investors instead of the employees and the founding team, which doesn't add any value to the acquiring company. They want more of their money to go to the investors and the founding team because that inspires them to stay with the company, or perhaps using golden handcuffs, it forces them to stay with the company. So they attach value to a few things that prove you have de-risked a certain stage in the business growth successfully. Now, if you're in the trough and you aren't generating what I call real-world value as opposed to notional value, just the potential, this brings me to my first rule of scaling. You need to raise enough money to get across each chasm, especially that first one. The risk of scaling is great enough as it is, and if you try and do it without sufficient runway for you to get there, then you end up missing a valuation peak and getting stuck in that valuation trough. How much money do you need? How much runway do you need? Well, I'd start by answering the question, how much do you think you need to invest to get to 5 million in annual product revenue? And then perhaps multiply whatever you think you need to get there by at least 1.5. And to be able to intelligently answer that question, you definitely need to know what your current customer acquisition cost is and what to do to reduce that to something that will allow you to scale profitably, what your sales cycle time is, what your conversion rates are. We meet companies that are looking to sell all the time, and they don't know these numbers for their own businesses. And the thing is that if you get into an acquisition discussion in due diligence, you have to actually calculate these numbers anyway. So it doesn't make sense to have to calculate them for the first time when you don't need them anymore. You're much better off calculating these numbers, applying them to your business, and then being able to reuse them when you get to the point where you're ready for an acquisition discussion. Now, unless you really missed the mark on your product, your heavy investment at this point should be in a salesperson who is laser focused on growth and or a marketing person who has proven demand gen record. So you'll have customers now and still semi-pretend products So you will also probably still want to invest in product development and customer success resources. All of that brings me to my second rule of scaling. Your sales and marketing hires will make or break your chances of successfully crossing that chasm. You want people who have done it before and who can not only get you the numbers, but who spend time thinking about how they can turn it into a repeatable process. And again, we often meet companies that are hovering around 2 million in sales, stuck in the trough of disillusionment. And what they do is they hire junior sales and marketing people. They're not strategizing how to cross the chasm. They're just trying to meet their quarterly goals in any way they can, which tends to not make it a repeatable process and doesn't allow you to show a potential investor or acquirer that you've figured out how to capture this market segment effectively and efficiently. And that brings me to my third and final rule for scaling, which is that if you find yourself with less than 12 months runway, you are operating in the danger zone, one of my favorite movies. Because data shows that the median time between these big milestones that lead to the next round of funding or an acquisition is about 2 years, which means that yours could take 2 years, it could take 1 year, it could take 3 or 4 years, right? That's just a median. And as I'll show you in a bit, unless you've been investing in an acquisition strategy alongside your scaling strategy, you will find that it takes at least 12 months from the start to get a company sold if you haven't been prepping the market in advance. So if you have less than 12 months runway and you don't make it across that chasm, and then you start thinking about selling, which so many companies do, you might not have given yourself enough runway to get there. Okay, so I've talked a lot about how to think about approaching your next scaling milestone, but what if you're one of those, I think, reasonable people that expect to get a solid financial return from all of this work that you're doing? Well, there's 2 stories I want to focus on in this part of the discussion. One is what I call the value generation story, which I've already been talking to you about, and the other is what I call the dilution story, which you intuitively know plays a big role in the financial outcome of your startup. The best average valuations tend to cluster around companies with total capital raises of between 2 and 3 million, and then between 5 and 10 million, and then upwards of 20 million. Exit prices, so the valuation that an acquirer will assign to you, tend to drop after companies raise around 3 million-ish, and then drop again after companies raise around 10 million, and then they take a time before they recover. So you've been staring at this diagram long enough now to realize that there are points along the life cycle of your company where your exit value is the same despite the fact that you've put a lot more time and money into the business. A study by the firm Exit Round found that valuations peak in clusters around these $2 to $3 million marks and these $5 to $10 million capital raise marks. And the data aligns with this diagram that I've been showing you. So for people who are interested in maximizing their financial outcome, our first rule is that your valuation is not linear. You will have peaks and valleys. If you want to maximize your valuation, you have to think about the timing of your exit rather than just driving forward with growth efforts and then letting the chips fall where they may and deciding on an exit only when everything else is potentially not working quite as well. Couple this story with the dilution story. So if you care as much about your team's return on investment rather than just your investors' return on your investment, then you don't want to just look at the overall value of the company, which is what I was just talking about, but also your ownership interest over time and how an acquisition price waterfalls or gets distributed among investors, founders, employees, and shareholders. So this is a chart, a little complicated, that was generated by CapShare. And what it shows is the average and the median values of the stock held by the founder group at different levels of funding. So the average or mean values are the gray line. And the first obvious thing you'll notice is that the growth in value for the mean gray line is significantly larger than the median line, which is in orange. And so that obviously implies that raising additional rounds of funding is fantastic if you're one of those wildfire growth startups, the 2% in CB Insights data. The economic rewards for adding more funding rounds there seem to be quite enormous. But if your company is more of a median company, the economic rewards of raising more and more venture capital funding tend to be much more muted. And that's not even where the analysis ends, because you also have to overlay the opportunity cost of continuing to raise capital as compared with selling your company and the stock in it before you get further diluted. So let me show you these 3 points. This is a seed series point, a series B point, and a series C point along a founder's value curve. And if you're a median company and you decide to continue to raise until Series B, you need to remember 2 things. First, that's about 4 more years of your life to get an increase in take-home pay from seed to Series B. And only about 28% of seed companies make it to Series B. Of those, an additional 20% exit and the rest fail. So if you decide, okay, I'm going to push on all the way to Series C, because as you can see, Series C seems to be a little peak in valuation for founders. You also have to remember that that's another 2 years on median after Series B, sometimes longer, of your life, and another chance of not being able to cross the chasm and then failing before you reach that valuation point. So this chart, as complicated as it is, brings me to my second rule, and that's in addition to thinking about the timing of your exit, you also need to calculate how much dilution is acceptable to you, given the number of years you're likely to still going to have to put into your business before you can exit. And there's no wrong answer here. Some founders do this calculation and they realize that they can make $3 million now and then spend the next 4 years building something else that they can fund themselves. And others don't really want to do anything else. This is their passion project. And so this is the business they want to grow, and they'd be perfectly happy if they spend 4 more years doing it and exiting at, maybe $4.5 million after that. Okay, so we're done with the stats, but let me show you one more thing that you should think about. So the green circles are when your acquirers are most likely going to be interested in buying you, because your company's doing well, you're getting a lot of excitement and energy probably from your customers, and so things are looking up. But our experience working with startups is that you're not interested in selling at those times for those very reasons. Your graphs are all going up and to the right, and you're super excited. It's when you hit the red circles that you decide, maybe I do want to sell. And that's often when we see companies coming to us. But the price they want is usually somewhere around where they last peaked, while an acquirer sees this as an investment that has happened that hasn't yet translated into another milestone achievement. And so if they're willing to buy at all, they want to do it at a discount. So just to wrap up my rules, my very last rule is if it's a bad strategy for the stock market, it's a bad strategy for your company. You want to avoid what is a natural human approach of thinking, I'm doing really well, I don't want to sell now. Oh, I'm not doing so well anymore, now's the time to start looking for a buyer, even though it seems to be what the vast majority of companies tend to do. The best time to reap the rewards of financial rewards from your company is really close to these peaks. Again, just to recap, when you've proven your product market fit by having a handful of big customers that are willing to pay for your product and say wonderful things about you, or at the second point, when you've proven that you've cracked the code on how to capture this market segment effectively and you're generating you know, in the area of $5 million in product ARR, and you've got a really low customer acquisition cost, and your growth rate is strong, or once you manage to get through all of these chasms and you're actually securing a market segment. So that was a pretty data-filled walk through the life cycle of an early stage company and how to think about growth as it is relevant to your valuation and to your definition of success. But regardless of how you define success, I think that you should be constantly investing and strategizing towards a successful exit. So why? I've got 3 reasons. First of all, relationships take time to develop. So when I was buying for a large public software company, I would get approached by a couple of new companies every week and interested in selling to us. And the company I was working for at the time had a market cap of about $6 billion or so. So imagine how often companies like Google, Facebook, Amazon, Apple, Cisco, Oracle, all of those companies, imagine how many times they are approached every single week. And for me, as I was trying to filter through the massive inbound startups looking to sell to us, what we tended to do was we would go out and we would try and meet companies that we were interested in, even far before we were interested in actually buying them and developing relationships with them. By the same token, companies that came to us and just wanted to show what they were doing and maybe enter into some sort of partnership or joint marketing effort, gave us an opportunity to get to know them before they wanted to sell themselves. And so when they came to us with an interest in being sold, we already knew who they were, and they managed to rise above the noise of all the other people that were trying to approach us. So the way to get into the most acquisitive companies, which are the ones that are also the most likely to be regularly buying and maybe buying you, is to have them get to know you long before you want to pitch them for an acquisition. How you grow affects who might buy you. So I worked for a startup that sold developer tools. And we started off growing at a really nice clip, and we managed to get a really good Series A valuation at a great set of terms. But then after that, our growth rate slowed because it turns out the developer tool market isn't a multi-billion-dollar market out there. We're still growing, mind you, but not as fast as our VCs wanted us to. And we were getting a lot of pressure to find another market to sell into. So the company decided to start building a security product. Why? Because their goal was to scale, and they needed to find another market to sell into. The problem, as I was telling them, is that security companies aren't in the business of selling developer products, and developer tool companies aren't in the business of selling into CIOs. So the only companies I could think of that would be interested in assigning a valuation to both of their product lines were going to be HP and IBM. They played in both of those markets. But neither of those companies were buying much at very strong multiples at that time, and quite honestly, they're still not doing that today. So they were really quite limiting their maximum valuation potential by making this particular business strategy decision. The company eventually sold itself, but the work it did in building the security product wasn't very helpful because it didn't bring up the valuation of the company. A lot of investment made, not a lot of value extracted from that at the end of the day. So a strategy to scale is different from a strategy to sell at a strong price, and most people don't understand that difference. And then the final reason I'd say that people should be thinking about acquisition strategy early is that timing isn't often in your control. So this happens quite frequently to us. A company comes to us looking to sell, and they're saying, oh, there's 3 companies out there that are perfect acquirers. And so we start reaching out and developing the material and the analysis and talking and investigating, and we discover so many different things along the way. One of the companies maybe just missed its numbers and aren't focused on acquisitions for the next 6 months as they reorg. Or this actually happened. One of the companies, right before we were about to approach them, announced a large merger, which was going to take up all of their bandwidth for the next 9 months. And so they didn't have any time to think about any other acquisitions. One of the companies actually just changed their CEO right after we'd been talking to them for about 3 or 4 months. And so all the exec team members, including our champion, were sitting tight waiting to see if the new CEO would change the company strategy, and so on and so on. And so it's much better to be on the radar screen of these potential acquirers so that they can approach you when they're ready to buy, instead of waiting until you're ready to sell, only to find out that they're preoccupied with higher level priorities. So hopefully I've convinced you that your exit strategy needs to be constantly evolving. It's an evolving strategy of your company, just like your customer strategy and your marketing strategy. It's not something that you should be starting and considering when all else has failed. Before I wrap up, I wanted to say I've talked about how VCs think. I've talked about how I think startups would think. But let me just talk a little bit about, give you some insight into how acquirers think about buying companies. So when we work with startups, first thing we ask them to do is to work with them to define their value drivers. And that's because acquirers think about acquisitions in terms of strategic rationale or value drivers. And from my experience, I can categorize almost all acquisitions into one of 4 value drivers. So the first one, obviously, the one that everybody thinks about first, is the financial value driver. It's where the company is making an acquisition in a segment it plays in because the seller will add material revenue or profit, or both, to the acquirer's top or bottom line. And the key here is that the revenue has to be material today. So often we'll see an early stage company and they're trying to sell with a value driver of revenue, but their pitch is that in 5 years, this will be our revenue. But that's not how acquirers think when they're buying for revenue. They're buying for something that will change their revenue or change their profit next year. And oftentimes these forecasts are like, if you just invest in me next year, there might be a little bit of a loss, then you should see what happens 2 years from now. Everything goes up and to the right, just like a hockey stick, which, I mean, most acquirers have never seen a diagram that doesn't do that. So financial acquisition is about revenue that the acquirer can add next year, not in 5 years. And if you can't meet the revenue threshold that is relevant to the acquirer you're talking about, then don't pitch your value driver as being the revenue you can bring. You still have to be able to create a forecast, but you have to separate that forecast from what the value driver is. So perhaps instead you fall into the second value driver, which is relationships. This is where a startup has relationships with customers or a community that an acquirer wants. So your relationship might be because of brand loyalty your customers have, because you've got a very, very distinctive brand that everybody loves to work with. Or it might be because you have a group of customers, deep relationship with a group of customers that the acquirer wants to consolidate with their customers so that they can try and own a specific market segment. And if that's your value driver, then you should be spending time stressing the depth of those relationships as you're developing your relationship with your potential acquirers. Now, if you don't fall in either of those categories, then perhaps your value driver is simply the second valuation peak I was showing you in the life cycle diagram. That's the peak where you have proven that you know how to capture a market segment efficiently. You've captured the market segment. You haven't captured the full market segment yet. That would put you in one of the first 2 categories. But the good news is neither has your acquirer. But you can show them that you know how to do it, and so you're de-risking their chances of success because they can acquire you instead of trying to figure it out themselves. And then if you're not even there yet, then you might be at the first valuation peak, which is that you can show that you've built something that is in demand and people want it and people will pay for it. So you haven't shown that you know how to scale yet, but there's still value in having this technology plus people acquisition for most acquirers. The biggest value in investing here for an acquirer is that they can capture a product that has been shown to be in demand and a team at a price point that isn't as high as what the expectation would be after a startup has received a bunch of funding. So after funding occurs, valuation expectations increase dramatically. And as I pointed out, what acquirers view the value to be starts to be quite a valuation gap between what acquirers perceive the value of the company to be and what the seller perceives it to be. So being able to get in before those big rounds of investments have a lot of value for potential acquirers. Now, very quickly, because I think I am way over time, I'll just quickly go through sort of the timing. If you have a term sheet delivered to you, you can expect to be able to close the deal within maybe 2 months, maximum 3 months usually. But if you haven't done any pre-work in prepping the ecosystem of acquirers along the way, you might find yourself spending up to 12 months in order to just get that term sheet delivered, which is why I say that you have about 12 months of runway. And if you haven't been actively developing your acquirer relationships early on, then you might run out of time before you can sell your business. So in summary, I just want to summarize the 3 things that we like to talk about with startups. Understand that the valuation life cycle is not just an up and to the right thing, and that it affects your exit opportunities. Try and decide whether to scale or sell depending on your definition of success and where you are along any point in that life cycle. And always think about increasing the exit value by building an acquisition strategy early. And that's the end of my presentation, and I'm willing to take questions now.
Awesome. That was fantastic. I learned several things. You've educated me greatly. A few questions here. The first one, what would you say is the largest difference for a self-funded startup as opposed to those on the funded model across this presentation?
That's a great question. A bunch of differences. I mean, a self-funded startup, if to the extent that you can do it, it's fantastic for a few reasons. One is that, and something I didn't have a chance to talk about in this presentation, is that you get to make your own decisions. So once you hit a certain level of funding, usually Series A, definitely Series B, you're handing over a fair bit of control about your decision to exit to your investors. They end up having preferred shares in your company. Preferred shares usually in and of themselves carry some veto rights unless you've created some really good terms as part of that funding. Also, they might sit on your board, and that has an effect on what you can get approved in the way of acquisitions and sales. If you're self-funded, then you retain more control to be able to make those decisions. And I think that's the single biggest positive. Obviously, a lot of negatives coming with self-funding. It might limit your ability to grow, but that's the single biggest positive I see.
So if metrics are equal across a funded and a self-funded startup, that does not impact the valuation, really?
Not at all. Not at all. Investors investing in a company doesn't have in and of itself a difference as long as your metrics are the same.
Okay, cool. So if you have 3 out of 4 of the acquirer value drivers, should you only focus on one specifically? For example, try and determine what the acquirer is. Okay.
Yeah, sure. The more value drivers you can put in front of an acquirer that are true and really relevant to an acquirer, obviously the more persuasive your pitch will be. In the same way as if you're raising money and you have a great team that has done it before and a product that is completely differentiated and a huge market, you want to raise all three of those points to your investor. So, you don't want to limit yourself, but all I'm saying is that most of the time people don't have all of those different things. They have one that really sort of stands out compared to the rest.
Questions around international startups and their acquisition opportunities. One being a company that's Canadian, predominantly Canadian client base. How does that valuation compare to U.S. companies? And then there's one in the Caribbean. So yeah, let's club those together and let us know your thoughts on that.
If you're trying to sell into the U.S. market, which is where all of my expertise is, and you're a company in a different geography, another thing that you're considering when you're positioning yourself for an acquirer is, does the acquirer want to buy and have operations in that other geography? Or are you planning on closing shop and moving everybody down? And so you want to think about your pitch from that perspective. When we work with companies, if they're international, we actually look at the potential set of acquirers and where their R&D and sales operations currently are, because if they actually already have locations there, then it's a much easier pitch, and you can actually include that in your pitch to those acquirers. So being able to look at where your potential acquirers currently have operations, and then deciding on the likelihood of whether they'd be interested or not, with that as a factor in your analysis, is part of the strategic development of your acquisition plan. If an acquirer has never acquired a company outside of the U.S. and you're outside of the U.S., well, and they don't have offices there, that's you're going to have an extra hurdle that you're going to have to account for there, which doesn't make it impossible, but you have limited time and you have a lot of options. And just like when you're looking at VCs, you want to maximize the time with the people that are more likely going to be interested in you and your company.
Fantastic. One question about, and this ties to that, is would a U.S. company value a company with international customer base higher? And I think you answered that by saying if they care about that market, or maybe not.
Yes, yeah, absolutely. I mean, if you look at, for example, some of the financial regulation companies, because fintech's huge these days, it's a highly regulated place. And if you're looking at an acquirer that has only managed to tap the U.S., then they need to have already decided that their strategy is to expand internationally in order for you to fit within their strategy. One thing that I have found a lot is that companies looking to sell themselves think that they can impose their strategy on an acquirer. And so, we'll get a lot of this. Oh, yeah, but you guys can expand into the UK, and this will be fantastic. Well, that doesn't work. Acquirers have a strategy. Even if they don't have a strategy, they sort of have a strategy. And they don't often change it because someone comes out of the blue knocking on their door to talk to them about a different strategy. And so it's better and easier to find people acquiring companies who already have a strategy of international expansion and who want to get more international customers, if that's what you're pitching to them. Certainly if you're really large, you can change the strategy of an acquiring company. It's more of a partnership than a straight-on acquisition, but most of the work we do is not with super large companies.
Last question here. Actually, there's a few more, but question around the multiple. What's the average multiple of the ARR? Is it 5x? Is it more? Is it less? How does that get decided?
It's segment specific. I use 5x because that's sort of a rough number, but in some segments that are low growth segments, it might be 3x. If you've got more services or NRE, it might be 2x. If you're in one of the super hot segments, These days, it might be all the way up to 10x. I mean, if you've got a really, really hot market, it might be up to 10x. For early stage companies, the multiple may or may not be relevant. So if you look at a company that's operating with, $3 million in revenue, it's sort of hard, or less, it's sort of hard to start looking at multiples. It's more valuable to pitch the company based on one of the other value drivers, and then, how much you actually get purchased for is sort of a triangulation, a triage of a whole bunch of different things, where the multiple usually, the seller's trying to minimize the multiple because it's usually really high, and and show the other value drivers as being the biggest force for setting a price.
Excellent. Around valuation, so Anthony shares this link from AngelList Valuation and says the average valuations for companies coming out of an accelerator in the US is 4.2 million, and they've raised a seed round at about 6.5 pre-money, and that trend has created sort of larger super seed rounds. So do you see this trend continuing, and sort of how does this impact acquisitions, like raising large seed rounds and larger A rounds?
Well, it's a complicated question, so a number of different answers. The larger the investment you make, the what you need to, or you take in, what you need to realize is you're sort of agreeing to this unwritten rule that you're going to grow the company as large as you can. And you're going to try and hit that, 30 times return or 10 times return. If you do a 10 times return and someone else does 100 times return, then that averages out to 30 for the investor, right? So these large seed rounds that are like Series A, the Series A rounds, these are all investments that are expecting you to have that scale path in mind, which is fine as long as that's the path that you have decided you want to go on. The larger the round, the more likely that your investors are going to drive you forward on that path, even though you might make a really crushing amount of money if you sell earlier than that. So that's the push from the investor side. From the acquirer side, as I said, they don't really care. I never looked at an investment profile and said, oh, you've raised so much more money, that's exciting, I want to buy you for more.
Right.
So we always focus on the milestones that the company has achieved.
So there's this question about sort of unconventional by VC standards, or rather unsexy industries. So this is a diesel refining technology, and have you found that the conventional VC fundraising process and multiples are also applicable to unconventional technologies?
I'd say, as far as unconventional technologies, if you're selling into a kind of acquirer that is not the kind of segment that acquires it, the evaluations that we're used to in the tech world, in the more conventional tech world, then you're going to be stuck with a mindset in your acquiring base that says, we're not paying those kinds of multiples. So we dealt with a company like this, and trying to sell it into, let's say, the oil and gas space, where they don't necessarily do the kinds of valuations that we're used to in Silicon Valley. Your segment, your acquirer segment, is just going to have a different perspective of valuations, and so that's something to be aware of as you're growing and scaling your business. That you've got a set of acquirers that will not have the same valuation mentality as the high-tech companies in the world do. If you can position your company so that it's relevant to a different set of acquirers, then you're more likely to see a different set of multiples come out of it. So it's very segment-specific, is what I would say.
Awesome. So question around assessing the seriousness of a buyer. So how do I determine if someone's serious? What if they're trolling me? We're trying to figure out how sensitive should I be when sharing information?
It's a good question. I think from a buyer's perspective, if you're dealing with a large company, so I'll separate large acquisitive companies from smaller ones. If you're dealing with a large acquisitive company, they, generally speaking, don't have the time to go talk to a whole bunch of startups. They can steal their ideas. Now, that's not to say that there aren't companies out there, or people, I guess, in companies out there who might try and do that. But by and large, if you're talking to like corporate development at these companies, they're so separated from the people that are doing the actual work within a company that there's no real worry about doing that. And I think that there's much more value in building that relationship than there is of being afraid of it. Now, if you're dealing with like a larger private company, a company that's larger than yourself but private, and perhaps they're not a serial acquirer, in fact, they've only acquired one company before in their history, then, you can certainly have a discussion about the balancing pros and cons of giving away some information, even under NDA, because we all know NDAs are sort of, meaningless to a certain extent, versus not, because the chances of you being able to get this company all the way to an acquisition discussion for real is pretty low. But for the public companies, I think that there's much more value in just trying to build those relationships as much as possible.
We'll take the final question here. What happens when an acquirer comes back and changes their mind, either in terms of the deal value or decides to just back away? What do you do in those situations, or how do you handle those situations?
Yeah, those situations are really tough. It doesn't happen very often if you've managed to get past term sheet. So the big, gating item is getting an acquirer to give you a term sheet, negotiate that, and sign it. Then you still have a whole bunch of work to do until close, and certainly things can happen. But the human mindset at that point is that you've invested so much time in something that people are really invested in getting it done at all costs. So, I have seen deals unravel after term sheet sign, but they're really infrequent, very, very infrequent. So, what you really want to do is to assess how serious something is, see how quickly you can push a conversation to actually having a term sheet delivered to you. That's when you can really start assessing the seriousness of a buyer and being able to feel confident that they're not going to be able to walk away. If they walk away before term sheet sign, I'm not sure if they were that interested to begin with. Perhaps they found things about your company that they didn't expect. What we always try and do, and what I find startups on their own don't often do, is have another meeting with the buyer to understand what happened, because it's a good learning experience, so that when you take that to the next buyer, you know what to watch out for in advance.
Definitely. Thank you so much, Mona. It was fantastic. Lots of great information, lots of key takeaways. I will compile the recording, put it on our blog, and share it with everyone who attended. Thank you so much again, and have a wonderful day.
Thanks, Lloyd. Thanks, everybody.